If you think the big story in precious metals is about gold, think again. Right now, quietly, almost invisibly, central banks are stockpiling silver at levels we haven't seen in 4 decades. Not gold, silver. And they're doing it in ways that are almost impossible to track, using mechanisms specifically designed to stay off the radar of the general public. As I record this on January 8, 2026, silver trades at 75.16 per ounce. 12 months ago, it sat at 29%. That's a staggering 158 gain in just a single year, the largest annual jump since 1979. But here's the kicker. Despite what the financial media would have you believe, this is far from the peak. What we're witnessing is only the opening act of stage 4 in a pattern that is repeated 3 times over the last 150 years. And if you understand this cycle, if you can see the recurring rhythm, 150 silver isn't wishful thinking. It's almost a mathematical certainty. This isn't speculation, intuition, or luck. It's history repeating itself with remarkable precision. And right now, in real time, that pattern is unfolding once more. Most people have no idea what's about to happen over the next 18 months. Let me walk you through it, because once you see it, you can't unsee it. This is the story of silver through the lens of a 4-stage cycle embedded deep in monetary history. It's not academic conjecture, it's documented, repeatable, mathematical reality. Stage 1 is what I call the foundation phase. This is the era where governments lay down the monetary groundwork, usually backed by precious metals. Gold dominates the narrative. It's the king, the reserve, the celebrity everyone talks about. Silver, by comparison, is the understudy, secondary, overlooked, a poor man's money. Industrial use is minimal because this is usually before modern electronics transform demand. Everything feels stable, orderly, and permanent. Cracks haven't appeared yet, so nobody questions the system. Stage 2 is the debasement phase, and here's where things start to get interesting. Governments realize they can extend credit far beyond their metal reserves. They print money, they promise payments, they spend like there's no tomorrow. But the gold and silver backing doesn't grow at the same pace. Here, the gold-to-silver ratio stretches like a rubber band being pulled tighter and tighter. Gold maintains value, central banks hoard it after all, but silver gets left behind. Historically, the ratio hovers around 15 to 1. During debasement, it can soar to 20, 30, even 50 to 1. And the fascinating part, nobody notices. The economy still appears healthy. Markets are rising, confidence feels normal. Silver becomes forgotten, cheap, and ignored, perfect for industrial users, dull for investors. The rubber band stretches, unnoticed, until the snap becomes inevitable. Stage 3 is the crisis phase. This is where the cracks become visible. Currency loses credibility, inflation spikes, confidence collapses, banks fail, governments panic. And here's the twist. Gold alone can't stabilize the system. It's too expensive, too scarce. What's needed is a more abundant, historically recognized metal, silver, but they can't announce this publicly without triggering panic. So acquisition happens quietly, through proxy buyers, strategic reserves, or industrial necessity clauses. This stage is about stealth accumulation while the broader public remains clueless. Stage 4 is the pivot. The rubber band snaps. Silver doesn't climb gradually, it explodes. Central banks shift from quiet accumulation to desperate acquisition, and the gold-to-silver ratio collapses violently. We're talking months, not years, for moves that transfer vast amounts of wealth from paper assets into physical silver. And here's the brutal truth. By the time mainstream media covers it, the easy gains are gone. The smart money bought during stage 3, while the rest of the world is scrambling to chase, paying top prices for what was cheap only once before. Let's ground this pattern in history so you can see why it's not theory. From 1873 to 1896, for example, silver's journey followed this sequence perfectly. Stage 1 was the bimetallic standard, where gold and silver backed currencies evenly. Everything was balanced, and the gold-to-silver ratio hovered around 15 to 1. Then, in 1873, Germany and the United States demonetized silver, triggering Stage 2 debasement. Silver's price collapsed, ratios soared, miners went bankrupt, and entire states like Nevada, Colorado, and Utah turned into ghost towns. Stage 3 arrived with the panic of 1893. Banks failed, credit froze, unemployment soared. Governments realized gold alone wasn't enough and quietly started buying silver again. Stage 4 hit between 1896 and 1919, and silver exploded in price from 60 cents to 1.38, creating fortunes for those who had accumulated it during the crisis. The second modern example is the 1965-1980 period, the Great Inflation Silver Squeeze. Stage 1 was the post-World War II Bretton Woods system, stability, dollar-backed gold, silver coins in circulation. Stage 2 began in 1965, when President Lyndon Johnson removed silver from U.S. coins, largely to fund the Vietnam War and the Great Society programs. The gold-to-silver ratio stretched again. Stage 3 arrived as inflation spiked in the 1970s, culminating in stagflation, oil shocks, and economic chaos. Yet quietly, the government accumulated silver through strategic reserves and industrial stockpiles. Stage 4 hit from 1979 to 1980, sending silver from 6 to 50 per ounce, collapsing ratios from 100 to 1 down to 17 to 1. Those who positioned during Stage 3 became rich. Those who chased Stage 4 bought high and got burned. The third case, much closer to home, is the 2008-2011 financial crisis. Stage 1 appeared during the so-called Great Moderation of the 2000s. Stability was an illusion. Housing bubbles, tech recoveries, and central bank assurances masked underlying instability. Stage 2 was the credit expansion leading to 2008. Banks leveraged 30 to 1, derivatives exploded, the money supply ballooned without backing. Stage 3 was the crisis itself. Lehman collapsed, banks fell, QE programs printed trillions. Amid the chaos, central banks quietly bought silver through proxies, strategic reserves, and sovereign wealth funds. By Stage 4 in 2011, silver soared from 9 to 49 per ounce. The gold-to-silver ratio collapsed from 84 to 1 to 31 to 1, and wealth transferred from paper to physical metal. Yet, instead of a new Stage 1, the market repressed silver prices through paper markets, futures, and shorting, stretching the rubber band further until 2026. So where are we now? Stage 1 of this current cycle came after the post-2011 silver crash, when prices fell from 49 to 14. Stability, or the illusion of it, returned. Mining slowed, exploration halted, and the sector appeared dead. Stage 2 arrived with COVID-19 in March 2020. The Federal Reserve printed $5 trillion in 18 months. Government debt jumped from $23 trillion to $36 trillion in just 4 years, a 57% increase. Inflation was deemed transitory, until it wasn't. By the end of 2022, official inflation hit 9, and everyone realized the foundations were cracking once again. And here we are. Stage 3 has quietly unfolded over the past few years. Central banks are accumulating silver strategically, invisibly, preparing for Stage 4, the pivot, where silver will explode in price, ratios will collapse, and wealth will shift in months, not years. The rubber band is coiled tighter than ever. The historical precedent suggests that the next 18 months could create one of the most extraordinary opportunities for wealth transfer in modern financial history. Silver at 75 today may seem high, but compared to what Stage 4 can deliver, it's the bargain of a lifetime. Once you understand this cycle, once you see the mechanism, it's impossible to ignore. Silver is no low. Inger, the overlooked metal, the poor man's money. It's the lever on which the next major financial pivot will occur. And if history is any guide, those who recognize it now, who position quietly and wisely, could be poised to profit in ways that most investors will only hear about in hindsight. Real inflation, the kind measured the way it was in the 1980s, wasn't the paltry 6 or 7 reported. It hit closer to 15. Real wages plummeted. Purchasing power didn't just erode, it evaporated. And yet, silver barely moved. Why? Because the paper markets kept it suppressed. Because the narrative insisted everything would return to normal. People still trusted the system. This was Stage 2 in action, debasement happening in plain sight, while silver remained undervalued, overlooked, ignored. Now we're in Stage 3, the crisis phase. If you know what to look for, if you're not hypnotized by mainstream financial narratives, you can see it everywhere. Banks started failing in 2023. Not tiny obscure institutions, but the ones you've heard of: Silicon Valley Bank, Signature Bank, First Republic. Hundreds of billions in assets, gone or salvaged only through fire sale mergers. Credit Suisse needed a bailout to survive. Deutsche Bank is teetering. Regional bank stocks are down 40 to 60% from their highs. Commercial real estate collapsing. Office buildings in major cities are worth half what they were just 2 years ago. The Treasury market, the supposed safest corner of the financial world, suffered its worst year in 240 years in 2022. That's not a typo, 240 years. Let that sink in. But here's the data point that should make your blood run cold if you understand the historical pattern. The gold-to-silver ratio right now is 88 to 1. Gold trades at roughly $6,600 an ounce. Silver trades at 75, 88 to 1. That's higher than it was before every single Stage 4 pivot in modern history, higher than 1893, 1979, or 2008. The rubber band is stretched to its absolute breaking point. And just like every prior cycle, nobody is paying attention. Gold makes headlines. Silver, it's still the sideshow, the neglected understudy. That was true in 1895, 1978, and 2009. The smart money accumulates during Stage 3 when everyone else is distracted. Let's look at what's happening behind the scenes, because this is where the pattern becomes undeniable. In 2023, the Shanghai Cooperation Organization, which includes China, Russia, India, Pakistan, and several Central Asian states, announced strategic metal reserves. No specifics on amounts, no specifics on which metals, but silver imports into China hit a 10-year high in 2023 and stayed elevated through 2024. India, the world's largest silver consumer, increased silver imports by 57% in the first half of 2024. Not for jewelry, not for weddings, but for investment and strategic reserves. Russia, the world's 6th largest silver producer, explicitly included silver in trade settlement and BRICS Plus reserves. Why highlight silver if it wasn't monetarily necessary? Mexico, #1 in silver production, passed legislation restricting silver exports in 2024 unless domestic strategic reserves were satisfied first. Let that sink in. The world's largest silver producer is keeping silver inside its borders. Notice the pattern? This isn't coordination, it's convergent evolution. Independent actors, multiple governments and central banks all reaching the same conclusion: silver is strategically critical. It has monetary necessity and there isn't enough to go around. They're quietly scrambling to acquire it before stage 4 makes it obvious to everyone else. Now let's talk numbers, because this is where stage 4 becomes inevitable. Total annual global silver mine production is roughly 830 million ounces. Industrial demand alone consumes 570 million ounces. That leaves 260 million ounces for investment and monetary purposes. Suppose 3 major central banks each decide to acquire 100 million ounces. That 300 million ounces, 40 million ounces more than the total available supply. Math doesn't lie. The market cannot clear at current prices. And we're already seeing this unfold. The Silver Institute projects a 142 million ounce supply deficit for 2024, the 4th consecutive year in a row, where demand exceeded supply. Yet prices barely moved until recently. How? Paper markets, futures contracts allow trading silver that doesn't exist physically. But the divergence can't last forever. Someone eventually asks for delivery, inventory data confirms it. COMEX registered silver inventories have dropped from 400 million ounces in 2021 to 270 million ounces, a 32.5% decline. The London Bullion Market Association, the hub of global silver trading, saw vaulted silver drop from 1.1 billion ounces in 2021 to 300 million ounces by the end of 2024. That's a 72% decline in 3 years. Where did it go? Asia. Strategic buyers. Governments and central banks accumulating quietly during stage 3. This is precisely what happened before previous stage 4 pivots. The pattern is holding with mathematical precision. Industrial demand makes this even more explosive. Silver has the highest electrical conductivity of any metal. Solar panels, electric vehicles, 5G infrastructure, military radar, advanced weapons all rely on silver. Every solar panel uses roughly 20 grams of silver. China installs more solar capacity every quarter than the entire US installed in all of 2020. By 2030, green energy transitions alone will consume an additional 200 million ounces annually, 80% of the available investment supply gone forever into infrastructure that will never release it back to the market. Then comes monetary demand. When currencies collapse and confidence evaporates, people flee to tangible assets. Gold is first. It's the king. The wealthy buy it. But at 6,600 per ounce, gold is out of reach for most people. Silver at 75, that's accessible, affordable. Gold is for the wealthy. Silver is for the masses, and there are far more masses than wealthy elites. Now, here's a thought experiment that should terrify anyone not already positioned. If just one of global financial assets, about 1.8 trillion, tried to move into physical silver, consider this: the entire global silver market is currently worth approximately 63 billion. That's a 28-to-1 ratio. $28 trying to buy $1 of silver. What happens to the price? It doesn't rise gradually, it gaps, it explodes. Exchanges halt. Premiums spike. Physical silver becomes unavailable at any price. Not speculation. This happened in March 2020. Paper silver fell to 12, while physical silver sold for 22, a premium of 83 over spot. Dealers ran out, mints stopped selling, delivery times stretched from days to months. That was a microcosm of stage 4. Objections? Let's tackle them. This time is different. No. Every generation thinks so. Technology, innovation, American exceptionalism. They're comforting stories, but human nature hasn't changed. Debt still needs to be serviced or defaulted. Currencies still need confidence, or they collapse. Physics still beats paper. Silver cannot be printed, synthesized, or conjured into existence by central bank balance sheets. Fundamental truths last 5,000 years. They don't vanish overnight. Technology will save us. Nope. You can't 3D print silver, quantum compute it, or rehypothecate the physical supply infinitely. Someone eventually demands delivery, and when they do, there isn't enough. Paper markets are levered 100-to-1 or even 400-to-1. When confidence breaks, the system snaps. The government will confiscate silver like gold in 1934. Unlikely. Silver is industrially critical. Military systems, electronics, fighter jets, naval destroyers all require it. Confiscation would cripple both economy and defense. People would hide it anyway. Compliance in 1934 was partial at best. China will flood the market. No, China imports more silver than it produces. At ACC, accumulates, it doesn't sell. Exports physical metal, rarely. This strategy accelerates the stage 4 pivot. Silver has been manipulated for decades, it can't rise. True, but manipulation only works while physical supply exceeds demand. Once supply drops below critical thresholds, manipulation fails violently, as in 1980 and 2011. Shorts get squeezed. Silver goes vertical. We're approaching that moment again. Inventory data, import flows, premiums, they all confirm it. So, what do? How do you position yourself before stage 4? First principle, preservation, not speculation. Trying to time the bottom or top is a losing game. The winners accumulate during stage 3 and hold through stage 4. Physical silver first. Coins, bars, rounds, whatever you can control. Not ETFs, not futures, not claims. When stage 4 hits, counterparty risk becomes existential. Mining stocks? Secondary. They offer leverage, 3-1 or 5-1, but come with operational, political, and geological risk. Physical first, miners second. Understand the timeline, manage your psychology. Stage 4 pivots are explosive but preceded by months or years of stage 3 grind. Silver went from 29 to 75 in 12 months. That's only the beginning. It's tempting to think 75 silver means stage 4 is here, but it's not. Not yet. Stage 4 isn't a gentle climb, it's a lightning strike. It's going from 75 to 150 in 6 months, gaps of 10 in a single day, premiums so high you can't even buy physical metal. Right now, the accumulation phase feels boring, even frustrating. Prices rise quietly, seemingly uneventfully. That's by design. Smart money is positioning while the crowd is still distracted. Most people notice silver only when it hits 60 and sticks. When CNBC starts broadcasting Silver Mania segments, when your brother-in-law emails you asking if you should buy, by then, the easy gains are long gone. If you want to benefit, you want to be buying at 30, adding at 50, and positioned at 75, not chasing at 120. The first rule here, ignore the noise and trust the pattern. There will be false breakouts, sharp corrections that feel like the rally has died. Mainstream media will publish headline after headline predicting a collapse. Analysts will call tops, none of it matters. The fundamentals driving stage 4 don't care about sentiment. Supply deficits don't read technical charts. Industrial demand doesn't respond to opinion columns. Central banks accumulate silently, and they don't care about your feelings either. The drivers of stage 4 pivots are in place right now. This is not speculation, it's mathematical reality. Prepare for chaos. When stage 4 hits, the ratio snaps and silver goes vertical, the market will behave in ways that seem irrational. Premiums explode, dealers run out of inventory, mints ration production. Delivery times jump from weeks to months. Major bullion dealers impose purchase limits. If you wait until the pivot is obvious to everyone, you won't just be paying more, you might not be able to buy at all. This isn't hypothetical. This happened in March 2020 on a small scale. In 1980, it happened on a massive scale. When everyone wants silver at once and physical supply is gone, price becomes almost irrelevant. The ability to acquire the metal is what matters. Preparation means positioning now, during stage 3. While it's still possible, but let's step back because this isn't really about silver. It's about understanding systems. Recognizing repeating patterns in history, positioning yourself on the right side of mathematical inevitability. The 150 silver target isn't a guess, it's a consequence of government debt that can't be repaid, of currencies that cannot maintain confidence, of industrial demand that cannot be met with current supply, and of a gold to silver ratio stretched beyond historical norms. Central banks are buying the gap quietly, through invisible mechanisms. They don't do this because they want to, they do it because they have to. History has taught them the lesson, from 1896, from 1980, from 2011. Gold alone isn't enough when the system collapses. They need volume, they need monetary mass, they need silver. And they're accumulating it now during stage 3 because they don't want to compete with the masses in stage 4. They want to be positioned first, done before the herd realizes the barn is on fire. But here's the thing, the pattern doesn't care about timelines or intentions. Supply deficits obey math, not calendars. When physical supply drops below critical thresholds, paper markets break. Price discovery shifts from futures to physical dealers. And when the gold to silver ratio snaps back, it does so with a force that shocks even those who expect it. We are seeing the setup unfold in real time. The Shanghai Cooperation Organization announces strategic metal reserves. BRICS Plus programs discuss trade settlements. Record silver imports flow into China and India. London vaults drain. COMEX inventories decline. 4 consecutive years of supply deficits. Every piece falls into place just as before previous pivots. The only unknown is timing. History teaches us timing is deceptive. The transition from late stage 3 to early stage 4 happens faster than anyone anticipates. It's not gradual or smooth. Think of water suddenly freezing, or a forest fire leaping from tree to tree. One day, everything seems stable. The next, the system reprices. One day silver is 75, a month later 120. One day you can buy with manageable premiums. The next week, dealers are sold out entirely. The people who understand this pattern are acting now, today, without waiting for media validation or perfect entry points. They're buying physical silver. They're positioning in quality mining stocks. They're preparing for stage 4, while everyone else argues about recessions, soft landings, or inflation forecasts. Those who ignore the pattern will chase silver at 80, 100, or 120 and wonder why they're always late to major moves. They'll rationalize their hesitation, wait for pullbacks that never come, and watch a generational wealth transfer unfold from the sidelines. This is the most critical positioning window of your investing lifetime. Not might be, it is. Stage 4 pivots don't happen every year or decade. They happen once per generation,